CPI today coming into a market that has tentatively celebrated this decline in longer-term bond yields. That Bank of America Global Fund Manager survey, kind of interesting because investors seem to have taken the opportunity of the correction in stocks and the drop in bond prices to actually raise their exposures. Where are you situated right now in terms of your expectations for how much more the market can give us this year?
I think it's like max 2%. And I think there's probably, after that, more downside risk than anything. The way I'm looking at it is, at best, if we make consensus expectations next year of 250, which would, on the $250 on the S&P 500, that's assuming an 11% increase year over year. It seems totally implausible to me. You put an 18 times multiple on that, and that's where we are right now. So I just do not see mathematically how the market, as in the S&P, goes much higher from here.
Well, judging by the scare quotes you used around the market, I know that you're thinking that there are obviously lots of different segments of this market that are treated differently right now by investors. So you have the overall S&P 500 valuation, as you mentioned, looking a little bit full or rich. But then you have, I guess, the equal-weighted S&P is at like 14 times forward earnings. So what looks better or worse to you within that?
Right. And your first guest this morning laid it out, too, where he was saying they were all about value and small cap and things that are underpriced. So the way I'm looking at it is, I honestly think people have forgotten, investing 101, which is buy low, sell high. So I'm looking at it like you've got Google, which is Alphabet, which is representative of the S&P 500, which is trading at 25 times earnings and has 15% earnings growth. Whereas in our portfolio, we like things like Schwab, where it's trading at 14 times earnings and has 20% earnings growth ahead of it. So I think it's really time to sell some of the big winners and repurpose that money into stocks where there's really decent earnings growth, and then the multiple is much, much, much more modest. I think that's the move right now.
And what is your word of the day for investors that fits in with this stance?
Okay, so this is where it's like, it's good that I'm happy and smiley because my word of the day is so miserable. It's winter, right? And I was thinking of that Game of Thrones, like winter is coming. And so we looked at our disciplined growth strategy, and the biggest winners in that portfolio this year were Meta, Uber, XPO, Intel, Meta, Uber, XPO, all up 150, 170%. But why? Why were all of those stocks up so much? Because of cost cutting and headcount reduction. And well, that's awesome that they were up so much. When companies that are doing the best are up, and by the way, look at Apple's earnings, right? That was cost cuts too. When companies that are up so much because they're reducing headcount and reducing spending, that's really bad for the economy. So I look at it like, I don't think there's any way we're getting to consensus expectations. I think the multiple on the market is kind of the best it's going to get right now. Yeah. And I don't see the winners next year coming from huge earnings growth. I see it coming from factors of margin improvement through headcount reduction and capital spending controls. And that doesn't translate to a strong economy.